Good afternoon. This is Sean Golding with Golding and Golding, here to dive a little further into the proposed regulations that were issued involving foreign trusts and large foreign gifts. And it's the anti-avoidance rule, recharacterization. What does it mean? How does it impact you? Let's talk about it. So, from a baseline perspective, when an individual receives, or a U.S. person receives a large gift from a foreign person, typically non-resident alien, then there's some reporting requirements, and generally it's going to be Form 3520. Form 3520A is for reporting ownership of foreign trusts. This is just to focus on foreign gifts. So when a person receives a large gift from an individual, they have to report Form 3520. Typically, that's going to be a gift more than $100,000 under the proposed regulations. That there may be a cost of living adjustment, like there is for when a person receives a gift from a foreign entity. When a person receives a gift from a foreign entity, it's generally around 19 to 20,000, where the person has to begin reporting, but it adjusts each year, and so they're trying to propose that the large gifts from individuals should adjust as well, because 100,000's kind of stayed stagnant for a while now. In addition, when a U.S. person receives foreign trust distributions, those are reportable as well, and there is no threshold. So even de minimis distributions would have to be reported. So one of the key issues to consider is whether the transfer is really a gift. Oftentimes, there's no income associated with it when it's a true gift. Your grandma lives overseas. She's so proud of you. You just graduated. You moved from F1 to OPT. You're on H1B now, or L1. You have no credit, so you can't really buy a home. So she sends you a gift so that you could buy a home, and that's great. That's a gift, and you report it timely, and life goes on. Nothing happens. But what happens if you receive the gift and you didn't report it, right? You did some quick Google cursory research, and it looks like there's no tax on foreign gifts, so your CPA maybe didn't know, or your buddy you were hanging out with didn't know either. So you didn't file Form 3520. Now you've learned about it. You received, maybe it was like a $2 million gift or $1 million gift, and now you're like, oh man, it's going to be a 5% penalty times 5 months. That's 25%. So even on $1 million, you're looking at a $250,000 penalty, and there's no income implication, et cetera, et cetera. So then the concern is, from the IRS's perspective, is the taxpayer may suddenly think, oh, you know what? Maybe it wasn't a gift. Maybe it was a loan, right? Because a loan is not reportable. Maybe it was a dividend, and the taxpayer's done the math and thinks, well, maybe if they go back and just amend the return, maybe they could do a QAR, qualified amended return, et cetera. And it'll still be significantly lower than it would have been if they get hit with the 3520 penalty. In other words, is it really income? Is it really a gift? Is the taxpayer, did they get a gift, but they missed the Form 3520 filing, and they don't want to get hit with the 6039F Internal Revenue Code penalty, because those are hard to get rid of, especially with the recent reversal in Farhi. That was a 5471 penalty, which is foreign corporations, but the concept is the same. Automatic assessable penalties can be okay. So then what happens? If the IRS gets wind that the taxpayer really received a gift, but they didn't report it as such, then first thing they're going to do is they're going to recharacterize, right? Recharacterize your loan transfer as a gift, which means you should have filed Form 3520. Now, if you didn't file Form 3520, what happens then? Well, if you didn't file Form 3520, you can get hit with penalties. Those penalties are typically going to be 5% of the gift, up to a maximum of 25%. But what could happen then? In addition, the IRS goes further into the tax returns. Maybe they find some unreported income. Maybe you have FBAR. Maybe you were filing FBAR, but you've got these large accounts generating a lot of interest. That interest is tax exempt in a foreign country. You didn't realize that you had to report it here. Then there's the potential underreporting penalties, and if they think fraud is involved. But typically, it's not going to get to that level. Substantial underreporting, things like that. For taxpayers who are out of compliance, there's various ways to get into compliance. Some of the offshore amnesty programs include VDP, but that's for people who are willful. And then for people who are non-willful, which is a majority of the time, not always, but majority of the time, there's a lot more programs. There is the streamlined procedures, the delinquency procedures. Taxpayers may also qualify for reasonable cause if they can show the non-compliance was due to reasonable cause and not willful neglect. We've got a ton of free information available for you guys on our website. We've got some sub-websites as well focused on specific issues such as FBAR, 3520, etc., etc. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.